What's going on, guys? Happy Tuesday. Get started in a second. Just get everything situated. I don't remember the last time I streamed. I feel like I've been saying that a lot lately because I haven't been consistently streaming. You guys know me by now. I come on, I stream for 3 days in a week. I say I'm going to get back to doing it consistently. And it turns out that that is, I don't know, not something that's really that even desirable lately, given the way that the market is trading. And now that I have a 5-month-old, four going on 5-month-old, yeah, there's a lot of reasons for me to step away and be flaky. That's what we'll call it. I'm being flaky. But I promise when the market is ripping and roaring, I will be back consistently. And I've also been working on that new video series, so that will be something that will be released on the YouTube, hopefully within the next month or two. The problem with that is some of the actual content that I plan on putting up was video content of the DOM, specifically during good trading sessions. And again, you know how that goes. It is May. And for those of you that wrote me off when I said sell in May and go away, and I had said that, hey, it's not about the market moving down. It's actually about the market just being undesirable to trade, volumes and liquidity drying up. Well, now you know we're more than halfway through May, and you could see that there are a lot of alternatives to trading right now, better alternatives. If you live in an area where the sun is out and it's warm, it is difficult to stay inside at the desk when you have other things you could be doing, right? And if you've made money this year and you've done well, well, then you deserve to do that, right? You should enjoy the fruits of your labor. Anyway, Let's give it a minute or so. The problem with not streaming consistently is that I fall off the map, the algo map. So make sure that if you're not subscribed, you go ahead and hit the subscribe button, hit the like button, show me some love. Even though, like I said, I do not deserve your love because I have not been consistently on this platform. I would appreciate it though. We'll get started in a minute. And yeah, we're going to keep this stream pretty casual. I have not been trading a lot lately. So, you know, if you take a week off of trading, if you're someone who trades primarily short term, if you're a low to mid time frame trader, if you take a couple days off, you can be completely out of the loop and off of your step and off of your game with regard to feel. I haven't seen myself be off of my game because it's not like I've been coming back to the market and trying to just like jump back into the swing of things aggressively. I've been really just enjoying this period of sort of stepping away and relaxing a bit more. But if you do come back, like if you take a week off and you're a trader like myself, you really have to kind of just observe for, I think, the first session back. That's just how I feel. That's how I've been now going on 17 years of doing this. If I take time away from the market, I need like a session of sitting back in front of the desk and just observing and yeah, seeing where we left off and seeing how the markets are behaving. So I'm not gonna hop on here and act like I've been on the ball and you know, looking at the market through a microscope, but I think it'd be a good opportunity to take some questions, point out, I think, some things that are rather obvious. Take a look at some things that I will look at from time to time. We have Amber Data Platform open, so we'll look at take a look at that, and then yeah, hopefully field some AMA and wrap it up pretty quickly. The sound is good, right? Hopefully the sound is good now that I've gone on that little monologue. As long as I get a good sound check, we'll get it started. Hopefully you guys are having a nice evening so far. Yeah, I've just been spending most of my time with my daughter, which is, you know, for anyone who's a dad, probably understand that. Yeah, I will definitely, I'm guessing the sound is working because you guys are kind of responding to what I'm saying. Anyhow, all right, so before we get into it, as I said, please hit the like button, hit the subscribe button, and shout out to the partners and sponsors of the stream, Bybit. Yes, I am still working with Bybit. If you are able to KYC, if you are someone who falls within their jurisdictional framework, then go ahead and use the link below because there are still bonuses that are attached to that. If you're someone who doesn't want to trade on a centralized exchange, they actually have, through their exchange, access to the Apex DEX. So you don't have to KYC to use that, and you could get access to that through the links below as well. Bybit is a phenomenal exchange. They lost a little bit of volume in, you know, over the course of a couple days from implementing full KYC. But as I've said before, this is the route that almost all exchanges are going to go, and it's just a matter of time if certain exchanges have not already. In order to play, you know, big ball, or in order to play ball with the big boys, you have to ultimately go this route. If you are a smaller exchange, you can get away with this. But yeah, obviously Bybit is one of the leading exchanges. So if you are someone who is outside the United States and can qualify, go ahead and use that link and you can get upwards of $30,000 sign-up bonus. Again, that is like not bullshitting at all. The $30,000 sign-up bonus, that's if you deposit, I think like $250,000 and you have to satisfy a trading volume requirement, which makes sense because they're not just giving away money for free. Okay, I will give a second to you guys to think of any questions you might want to ask. What you're looking at right now, so real quick, someone asked what the set was, I think. So I'm listening to Nonstop Techno Rave Radio 24/7 remix. Just to be clear, this is not music that I listen to on the day-to-day. This is not really music that I care for personally. It's music that does not get me into any trouble on YouTube. It's copyright free, and I haven't had any infractions so far. So you guys, you know, it seems like you guys like it. So I will leave that up in the beginning. Anyway, what you're looking at right here is a platform that I've been very outspoken about now for the last week or so. I was using Sandwich a couple months ago. This is a non-sponsored shill. This is probably the most professional order execution platform and trade management software that exists for retail, or rather that retail has access to. Currently, the platform is free, but I'm pretty sure they're going to charge what I think that something like this could command. Go ahead and check it out if you have not already. It connects to almost every exchange. It allows you to manage all of those accounts through one platform. And not only that, they have every kind of order type that you could possibly want. They have what you're looking at right here, which is quick trade. So just lift, ask, market, place bid, placed ask, hit bid, and then adjusting that by point value. And then they have a TWAP. So they have a time weighted average price. All right, this is something that I've gone over in the last video. It's very useful if you're looking to build a large position in a thick market. They have a percent of volume. So this is for your larger traders that do not want to leave much of a footprint, that are trying to build a position in something that is quite significant. And if you're moving significant size, and let's say that you're looking to build a 5 million contract position in something that only does, let's just for the sake of the argument, something that only does 10 million contracts a day, well, then it's going to be pretty obvious that there's someone, if on average the market is traded that value over time, that someone is getting involved. So this allows you to trade a percent of volume over time, and you could change the randomness of these order types. You could make them static, dynamic. And then we have scale. So this is scaling in. This allows you to adjust, where you're, again, let's say we want to buy 50K worth of BTC. We want to buy it between, 26,000, let's say 26,900 and then 26,000, 500. Now I can go ahead and, one sec. What just happened? Oh, it's opposite. Sorry. 26,900, and then we want to go down to 26,500. And when I want to buy 100K worth of BTC, and I want to buy it in 20 clips, and now I want to skew it either to be closer or lower away from that highest price relative to price. And then we also have, let's see, Swarm, Iceberg. Iceberg is basically hidden order. It's a phenomenal platform. So this is what I've gone back to using. Basically, I left them because they did not, they had awesome execution. So it's self-hosted. So the platform does not have your keys. The keys are on your computer. The execution is immediate. It's not routed through a third-party platform. Sends directly to the exchange. This is as professional as it gets, but they didn't have any order types really of any sophistication until recently. So this is a phenomenal platform. So you'll see me using this and sharing it quite often. And again, I'm not sponsored by them. I just think it's a fantastic product. And if they charge, if they charge $100 a month, it would be worth it. If they charge $200 a month, it'd be worth it. I don't know what they're going to charge you, but I know that something like this definitely commands a good premium. All right, so let me look at the chat real quick, and then we'll get into the chart. And I see someone already asking about. I see someone asking about the CVD on TradingView. I actually just discovered it, so we'll talk about that. Are there any other non-retail? Are there other for non-retail? Just curious. This is as close as you're going to get for order execution and portfolio management. For this, the Sandwich is as close to professional as you're going to get. So for anyone who's traded prop or traded for a fund or for a bank, it obviously, if you're trading on an exchange through their platform, you recognize that it's, some janky Robinhood type stuff. So it's a pain in the ass if you've come from either a TradFi background, a professional background, fund trader, desk trader, prop trader, and then you go to use exchange websites to trade and you realize that it's garbage. So there's more and more third-party software that there are more and more third-party software platforms that are coming out now to satisfy that market that exists where people are looking for better tools and better execution. And all of that. So a sandwich is definitely the best that exists right now. Another one is in silico terminal, which is phenomenal as well. But I've actually opted to use sandwich. But in silico is the terminal is excellent as well. So let's see questions real quick. All right. Okay. So like I said, I'm not really doing a whole lot of trading lately. Now, the S&P, the NASDAQ is making new highs, right? So the NASDAQ looks hyper bullish. New highs on the year, kind of a grind upward right now. Looking at the August 2022 highs at this point as the next major level. I wouldn't really focus too much on the NASDAQ. I think it's a little misleading right now. If we look at the S&P 500, it's a bit of a different story. The S&P 500 is a lot more coiled. So we're going to be looking at, for example, the ES, so S&P 500 E-mini futures contract. A lot more coiled, right? We haven't really done anything, haven't broken through that key level of 4,200. I think that the S&P is where you put your weight. I'm not exactly sure of what direction this breaks. It's been choppy. We have OPEX this week. Again, sell in May and go away. Seasonality in play. I can't really tell you where this is going. Listen, this is probably one of the most uncertain times that I've traded. You have Fed speakers talking every single day, pretty much a bunch of crosstalk saying something different each time, almost in the same paragraph in some cases. It's just, there's a ton of noise. But what we are doing is absolutely compressing and coiling over this multi-month structure. And this is going back to the end of March, the beginning of April, the April and May structure. This is consolidating under that key level. So that 4,200 level is, again, I think that's kind of the line in the sand. But I don't know. I'm really uncertain. I get this feeling that, if anything, what we get is maybe a break above 42. I think if we get a break above 42, it's probably some kind of exhaustive blow off. And then we get a larger correction. I don't know. I don't get the impression from this right now that it's going to break above 42 and we're looking at some kind of strong trend over the summer. PTJ, so Paul Tudor Jones, talked about the risk premiums being collapsed and the S&P and again, all risk that trades along with that. So you could kind of lump crypto in as being further out the risk curve, but probably trading, still correlated to the NASDAQ and correlated to equity indices. He talked about us grinding into the end of the year and maybe, moving up 10% from here. It's not the most positive outlook from really anyone. The most negative outlook probably comes from Druck, but Druck has always been more of a always been more of a doomsday guy, and he could say something and then completely change his mind, his positioning, and his words. A couple weeks after. So this hasn't really done shit. There's not really a whole lot to talk about. I'm not going to sit here and talk about if we end up breaking if we end up breaking 4K, we're going to come back down to trade 39, 38. I don't fucking have any idea where this thing is going. I mean, it has been stuck within a really tight range. The VIX is trading at 16, 17. Implied moves for the daily are off of that. If you just think of like the rule of 16. So 252 days in a trading year or 258. Don't quote me. The square root of that is 16. So let's actually do the math and figure out which number that was. So 16, 256. So the rule of 16, basically implied volatility divided by 16, and you get what would be basically your expected move for the day. So we're thinking, just along the lines of if we're talking about the VIX at 16 and 17. So, oh my God, I was looking at 1 day expiry, 0 day. So VIX is at 17. Your implied daily move off of that is 1%, right? and I say right because hopefully you guys just followed along with that. So you take whatever the VIX is, divide that by 16, and that is your implied daily move. So that's 100 basis points, and I don't know, what have we been stuck in, like a 50 basis point range for the most part? So half of that. So now if you look at the last, if we're just looking at the ES again, that was the S&P. If you look at the last 2 days, 86 basis points. The week range prior to that, 150 basis points. So I mean, it's pretty much par for the course. We're waiting for something, some kind of catalyst to spark a larger move. Maybe it's OPEX this week. You know, the last OPEX, the market was really pinned. I had mentioned that after OPEX, a week after, the market would have a lot more breathing room. We ended up getting that. So just as a reminder, OPEX is the third Friday of every month. So the second to last Friday of every month. So we are looking at the 19th. Yeah, anything can happen this week, but I'm not going to get excited about this. We're trying to predict where this is going. I think we're just clearly at the stage where it makes sense to be reactive. I think it always kind of makes sense to be reactive. I'm not going to sit here and talk about this in hindsight. You know, it's been a really clean range to trade. I haven't traded it. I haven't been as active the last couple of weeks. Last week and a half. So yeah, you're gonna have people that are talking about how clean this range was, and all you needed to do was buy the lows and sell the highs. And it's like, all right, man, we are 1, 2, 3, 4, 5. We are a week into this by now. If anything, we're closer to resolution than we are to any kind of continuation of the structure moving sideways. So not a whole lot that is standing out for me. I mean, if we're above 42, I would look at BTC and ETH to see if they are responding positively. You know, if we get some kind of bid above 42 in the SPX or in the ES, I'll be looking at the ES. Then that to me is probably something that has me a little bit more perked up. Otherwise, I'm not very excited. Vol can continue to remain compressed. We understand that it leads to expansion, but who knows how long that takes. And the market right now is really hedged. So it's difficult for a market that is really hedged to crash. So I think you do need a market that, it sounds funny, right? I think we do need a market. I think the more likely outcome for a move down is first to move up. So I guess, that sounds kind of funny because, it's not like I'm biased towards a move down really. But I think my point is, if we do get a move up, just be careful, because then it ends up clearing out a large amount of positioning that helps the move back down in the opposite direction, right? You end up taking that positioning out of the market. You take back that, or you remove that buyback pressure that exists, okay? Because when the market moves up, shorts are squeezed. Those hedges are closed out. You remove that buyback pressure. So if the market does at this point or at that point come back down through the level, there's just less standing in the way. So we talk about this dynamic in crypto, where I talked about this quite frequently. So same market dynamics exist, or same technical dynamics exist in legacy as well. So I think you just have to guard against that, or be mindful of that. If you do get a really bullish move above 42, yeah, I would just be careful, right? Be careful for the slingshot. Market is very hedged right now. What I mean by that is, if you just look at call volumes in the VIX alone, right? Because the VIX is this compressed, you have people that are longing, long vol, right? Anticipating some kind of expansion. That could come one way or the other. A lot of the times you get that. I mean, we had a regime where the market moved up, so the S&P was moving up and VIX was moving up together. But a lot of times you get that expansion of volatility when the market is moving down, right? So market is hedged, and as I said, it's difficult for a hedged market to crash. Anyway, let's get to BTC. It's the same, it's the same story with BTC, honestly, with where vol is. So if we look at, S&P index futures, if you look at the options on them, right, they're at the money. VIX is at 17, so we're talking about talking about, again, 1% implied, it's roughly 1%, right? The implied daily move. If we look at BTC, if we look at DVOL, we're looking at 52, right? So vol is really compressed as well. We'll scale this a little bit more so it stands out. This is on amber data, so this is just price in blue, but this is vol in the candles below. So it's lower than it has been going back to this time last year, right? So it's just continued to trend down. We need a catalyst, right? I mean, options writers, option sellers can continue to get away with selling volatility, and as long as they're hedged, right, it's not like they're not in any trouble, because this can continue to persist, and oftentimes it does. So oftentimes when you see an expansion of volatility, a lot of times people think that the correct response is to sell volatility, and when you see volatility compressed, a lot of times people think that it's the best time to buy volatility. But the truth is, you could end up getting eaten up by your theta if you're taking this route in options, because it could continue to just persist over time, right? What I will say is that if you're looking at BTC options, implied volatility is still pretty cheap going further out. So 60-day expiries, 90-day expiries, it's still relatively cheap. So if you want to pick up some long vol there, probably not necessarily a bad idea. I longed some June puts. The rule of 16 is not necessarily the same with BTC because this obviously trades 24/7. So that's, I guess maybe you would do the standard deviation, the square root of 365 to get a multiple at that point, to multiply the, not to multiply, but to divide this value by that. What would that be? What's the square root of 365? Someone in the chat. But I don't think that matters. If you look at ATR right now for BTC, it's around, I think it's $900. So the ATR is ATR for BTC for 24-hour session, for 24 hours, so a single session, 7-day look back, it's probably like 900 to 1,000. So I have ATR bands on, so it's going to be from, we're looking at 27.89. Yeah, so roughly 1,000. So this is 1x up, 1x down. So your average daily range, meaning your average price range over a 7-day period, has been about 1,000 points. For 30 minutes, so for intraday traders, you want to know what your 30-minute ATR is, what your 5-minute ATR is. I think this is around like 100 to 120. So 227.76 is the top band. You don't have to use ATR bands. You can just use regular ATR. So if you want to go to just the ATR indicator, you'll see it'll pop up down here, and that is around 105. So the average 30-minute candle throughout the day is about 100 points. So this gives you some kind of baseline, right? It gives you some kind of norm to judge movements against. If we're moving within this value or close to this value over a 30-minute period, that's normal. If we move 100 points in 5 minutes or 5 seconds, it stands out, right? If we move, if we're doing multiples of this in the 30-minute periods and you see this increasing, well, obviously you're seeing volatility increase. But you would use this for stop placement. You would use this for mean reversion trading, right? If you're looking to incorporate this, a lot of times traders will incorporate this into some kind of range trading strategy, depending on how much prices move relative to ATR, but I'm not going to get into that right now. But everything is compressed, right? Everything is compressed. I kind of lost my train of thought real quick because my wife, I think, just shut my door. Either way, so open interest right now is no egregious positioning that's built up. We've seen open interest pick up slightly since we've moved lower on the higher time frame. So since we've lost a weekly level, no real cause for concern. It doesn't look like a major squeeze is building right now. It kind of just looks normal. So I can't really say that anything stands out with respect to that. A lot of times in this market, it seems like people are really quick to fade any kind of increase in positioning. I mean, you want to have some kind of baselines or understanding of norms for open interest as well, right? A lot of times you'll see that when price is stuck within a range, the level of positioning that gets crowded at extremes kind of remains consistent. So you could backtest that pretty easily. You know, a pickup in positioning that's a couple hundred BTC, maybe you get a squeeze out of that if the market trades against it. But again, open interest is a lot of times just going to move with the trend. So if we have a market that is breaking market structure to the downside or to the upside, you're just getting more people behind the move, especially if you have a market that is compressed, moving sideways, and there's really nothing happening and people are losing interest. Well, when you finally do break out of that structure, you know, you might see one side get wiped from the inside of that structure, right? So one side that got in position because people get flat-footed in a range, you'll see it wiped, but then you'll see when the move continues that open interest will continue with that. You don't want to reflexively fade positioning, right? You don't want to look at every increase in open interest and say, oh, you know, we have to fade that. I mean, you're implying that basically no positioning can come into the market and be right, right? So if anything, what you need is to establish some kind of extremes for where open interest usually pivots. A lot of times, again, like I said, you could incorporate this. You could just backtest ranges and see how the market has gotten crowded at extremes, what level of open interest that was. Unless there's any kind of major change or catalyst that comes into the market, it's safe to assume that you might be able to lean on that value again in the future. So let's just for shits and giggles say it's like market gets crowded at range extremes to the tune of, you know, 20,000 BTC, 30,000 BTC. And then the market is approaching that extreme. You see absorption, non-constructive price action. And again, we have basically the same level of positioning built up. Then you have sort of a recipe for some kind of unwind, but you need that very significant positioning increase. You need mark-to-market losses. You need the market to trade against that before you could say that there's any like real trap that's built up. Right now, it doesn't look like anything honestly stands out. It just looks like the market is breaking down. People are finally seeing that and positioning behind that. And you have like on and off brief prints of negative funding, but they're all baseline. Like there's nothing that's outside of the what is just normal funding. So yeah, I would just be careful right now because I think that it's kind of this thing that, again, you see a little bit of an increase in open interest. And I'm kind of just talking about it right now rather than pointing it out. So let me just go ahead and point it out. We'll go to Coinalyze just to give you an idea of what I'm talking about. I have this habit of sometimes talking without pulling up the chart. And then we'll take a look at BTC. No, hold on. Not found. What's going on? One sec. Oh, why did it disappear? Weird. All right, either way, we have the open interest from Binance. We'll just use that. So this is ATR down at the bottom. We'll get rid of that. And then here's your OI. So if we look at just the last couple days, everything is correct. You have a slight increase in open interest overall, right? So just slight positive drift. My point is that this is not significant, right? Significant changes in open interest are where it matters is where it is. It's a matter of velocity, right? So a very sharp increase in a very short amount of time, right? So these very large spikes that you have, that's where you want to start paying attention. A little pickup intraday, at a low or at a high. I mean, if you just are reflexively fading those things, you're going to get run over. And it's not like that really yields much anyway. If you're looking at an unwind of like a $10 million position or a $20 million position, the market isn't necessarily hunting out that kind of positioning, I don't think. Yeah, the market is kind of thin. So, you know, maybe that gives you 100, 200 basis point move, but I think you'd probably be better off just taking off rather than looking to trade that kind of small opportunity. All right, so funding is pretty baseline. Open interest is baseline. Volatility is really compressed. It'll probably continue to be that way. So looking at where we are right now, ended up coming back down to that weekly open. We have an inside day setup right now. So, you know, if I was actually interested in trading this right now, this is what I would be focused on. We have I talked myself out of this short yesterday. We were looking at acceptance back within a 4-day composite, kind of rolled off of that. Looked like it was losing momentum and losing any kind of constructiveness into this level. I ended up shorting and then closing that out. But the target would have been that weekly open. So where we are right now is back within yesterday's structure. So you have an inside day. So inside day, yesterday's high, yesterday's low. A lot of times this is a pretty decent trigger. I think that in this context, the trigger is probably more applicable to the downside, just because you have this dead space in the 2 days prior to this weekly open. So we have that dead space below Saturday. This is Sunday, Monday's high, Monday's low. So it looks like you probably put in the weekly high. So we have a break in weekly market structure, possible weekly high put in. The trigger for this is honestly, because this is the high and the low and we're engulfed in yesterday's candle, it's simple. It's a break of yesterday's high. So a break of Monday's low leads to continuation, probably to the next major sticky point, which is probably back down here at around 25.7. That is, kind of myopic. I think that a break and continuation of the structure is going to lead to a further puke. I think on the high time frame, if we just look at this on like the weekly, I remember getting a lot of shit for saying that this was resistance, and I hedged prematurely at 29. This moved up slightly higher, but the most obvious sticky point on the chart is in a very technical market going to be probably a pretty tough area to chew through. So we failed there. We have an engulfing on the weekly. Now we have a break in market structure on the weekly. I think that with this, you're just going to have to be patient if you're short. Big ships turn slowly. This is a big range, right? So we're looking at a multi-month structure that finally has broken to the downside. Cleaned this up with a wick so far, but it's not like it's leaving that area with any kind of umph, right? So this is your low volume node. Been trading mostly within this high volume node between 31 and 27 for the last couple of months. Chances are, if we're going to be breaking down from there, it makes sense for us to fill out this gap in value, right? So this gap in activity rather. And how does that occur? Well, it could occur like this, or it could occur sharply down. But I think that ultimately you end up retagging that 24.5 region. I expect that this is probably going to fill out. Market doesn't look like it's, if you've been around long enough, you've seen periods where it looks like the market is always going to break down in that same day, right? That you're looking at the chart and then you realize like a month later, all the market did was slowly grind in one direction, whether that was down or up. I think that there's a good chance that maybe we just fill this area out and we don't have any kind of sharp moves. So I'm mindful of that. I wouldn't go ahead and blindly sell the high of the structure. But I do think that you do have to be patient with this kind of break. So, I'm not someone who trades purely based off of high time frame structure, but whenever it does change, I think that it is what you have to show the most respect to. I think changes in high time frame structure trump all changes, right? So they offer, in terms of first retest, great short-term opportunities to trade around. And then in terms of just defining the overall direction that I want to be part of, well, if we have a failure up here, we have a lower high that's created, clear signs of absorption at the high. You have a couple other things macro-wise that are lining up. I think that I want to get behind any kind of move back down to 25 as much as I can in the most attractive risk-defined way that I can. So unless we are trading back above 27.5, ultimately, if we're back above, like, let's say this week's high constructively, unless we're doing that, I would expect and anticipate that this is just going to take its time before filling out lower back down to 25. I don't really see anything in terms of looking at this and saying that this is adequate and we've had a good amount of positioning trapped down here and that this is going to lead to any kind of squeeze upward. I could see the case for why people might look at it that way though, right? Because you have a bunch of lows, you have a gap. Before I change this chart up, this was where my box was to look for a response to get long. I don't know. I don't necessarily see cause for concern if you're bearish based on how things are unfolding right now. If this is chilling here and the S&P is above 42, then I think it's a different story. But the way this is right now, I've seen too many times where it takes a level like this. There's a significant response. And then it gives you what ultimately you feel is, because you think that this is another higher low, a really significant amount of time to get in position and kind of just walk comfortably into position. And then this ends up just rolling over anyway. And because of this, you've cleared out a good amount of activity and brought in you've brought in even more significant long activity to help fuel this puke in the event that we end up trading back into this wick. And when this happens, so one of the reasons why I got short over here, when you have so just using this, for example, when you have the market trade into a level and you see a significant wick left behind like this, you don't want to see the market gain acceptance back within this region, right? Usually for me, it's more of like a 30-minute thing. So if I'm looking at the 30-minute time frame, and this was the example back here, this is where, hold on one sec, I don't know why the fuck that keeps popping up. I actually got short pretty aggressively right here. I was looking at this response thinking, all right, if that is the market showing you strength, it should actually continue to just bid up from there. Things that are really strong, when they leave behind prints like this, they end up taking this high pretty quickly. So if you end up trading back within this structure, kind of filling out that gap, and then you're unfolding, and you're folding back in the direction of this wick, I mean, you're just requiring the level of participation that we saw back here to do the same thing twice, which is unlikely, right? Because if you got involved here and you're thinking, oh, that's shit, this looks really good, and then you're trading back to that level, it's like, all right, let me split, reevaluate, get flat, and we'll see if it looks good after, right? But I don't want to hold on to this. So I think the same thing can be said when it comes to these daily prints, where if we're trading back below, if we're trading back below 26.5, this could get ugly pretty quickly, right? Does that make sense? But again, I don't want to just look at this structure in its entirety and say, we're going to fill this entire thing out quickly. This is going to be, the market is suddenly just going to roll over in a really ugly manner and take out that yearly open. Even though that stands out as an anomaly, that a lot of the times, again, when you have just think about the higher time frame you go, the more time you could give the market to come back and satisfy that. So when you have like an anomaly on a monthly structure, on a weekly structure, on a yearly structure, in that order of operations, in weekly, monthly, yearly, that's the amount of time that you should, or that is the scale that you should judge things by in terms of how long it should take for the market to return to those levels, or, clean that anomaly up, et cetera, et cetera. So this yearly open down here, the market could come back here in 6 months and fill that out, and that wouldn't be weird, right? That might be painful for some people, but it would certainly be something that Bitcoin, if there was one asset that was going to do it, would be Bitcoin. So if we end up trading back to 25, I'll look around that 24.5 region for, again, signs of constructive price action, signs of absorption, and signs possibly that the market is getting a little bit over its skis, anticipating that we end up taking out this low. I do think that there is something to be said for like symmetry in markets. You can see there is a little bit of symmetry between these structures in terms of the length of time from start to pullback. But in terms of the depth, again, just quickly doing this, don't get hung up on the exact points. I mean, we didn't get the full extent of that 50% retracement. I think I think obviously we end up getting, because I'm saying I think we come back down to 25. I think we get something similar to that structure, though. I mean, it's shaping up to be quite similar right now. I don't see a reason why this market would have a ton of money come into it, just the way that things are shaping up. If you think about it, like, if you're a normie on the sidelines right now, maybe you're looking at meme coins on the off chance you see someone share it on their social media and you think, I want a piece of that. But I think that a lot of people are looking at it and they're also seeing every other day some kind of negative headline regarding crypto and its impermanence and whether or not it'll be around. And they're thinking like, I don't know if I want to put my money in that because, this guy, Gary Gensler, is talking about it and they don't know much about markets anyway. So all they're thinking is that someone's going to separate them from their money at some point and that it's going to be made illegal. And we know that's not going to happen, but that's just how a normie's going to think. And I don't think that means that there's a lot of money that's chalking up to jump in this market. So I think you have to consider that. The market is finding fair value right now with the money that is already here. And I don't think that that allows for markets to really stay high for long. So, you know, if you sold this level, good for you. I think there was a ton of reasons to sell this level and to even get aggressively short around this level, right? So, all right, let's see. Again, keeping the stream pretty casual, as you can tell. I was talking about it on Twitter. Oh, this is my friend Mood's indicator. And someone asked, actually, I won't get into that. With regard to rebirth question, all I'll say is if you're in Fight Club, you don't talk about Fight Club, right? So I won't say anything about that. But specifically with respect to the CVD, I honestly, all I've done is visually cross-reference this. So I actually just lost my train of thought because this is really casual and I haven't, like I said, I haven't been paying attention to the market in the last couple of days. That inside day setup, just to leave you with something. High, low, weekly open. We ended up taking that weekly open. I think that's probably if I was going to say like gun to my head, what do I think is going to happen? I think the case is that we put in the weekly high and that this inside day low setup is the one to get behind. So what that means is a break of yesterday's low, right? So the weekly low, current weekly low. I think a break of that leads to expansion. And then again, it looks like a good amount of dead space back down to, what are we talking about? Back down to, what is that? 25.7. So something that ends up breaking yesterday's low. No immediate bid, no sign of absorption. I think this moves pretty quickly. You probably bounce off that POC. So that naked POC around 26.3. You fill out that value area, but I think this ultimately comes back down and tests that low. So if I was going to say what I think is going to happen, I think that that's probably has a more significant chance than the opposite, which is there as well. Like, it doesn't make sense for me to just point out what I think is going to happen. Inside day setup implies that the high and the low are both triggers. In this case, just because of the way the market is trading, I probably would 50-50 this, look for maybe another trap up here. So trap and then continued breakdown. But the implication is that if we do trade above yesterday's high, the implication is that the expansion out of that is more often than not, again, a good trigger as well. The same move to the downside, right? But again, I just think with a little less certainty this time around. And I think that you end up, because it's kind of like we had a gap. Ooh, one sec. We had a gap and then pretty much a gap fill. But above yesterday's high, it's not like there's a whole lot that stands in the way up to this high back here. So that 28.2 level. So you could probably see things move pretty quickly, right? If we start to get accepted above 27.6 up to 28.2. Again, it's not like there's a whole lot of meat on that bone, but that's what we're dealing with right now when volatility is this compressed and the market is just kind of doing a whole lot of nothing. But like I said, I would be mindful of a trap up here. Just because, I don't know, I'm not getting the strongest vibes from this. Inside day setups, right? Just the first time around, it could be something that ends up trending sideways longer. So it's not necessarily the case that it's a guaranteed break and continuation. So in the case of a move down, I would be more mindful of a trap because we're traveling through what is an area that has not been filled out the last, we've spent most of the time at the low, rather. So this is more of a grind where we are currently. If we get a spike up, I'm more prone to get behind or fade something that is a spike. So if we got something, let's say like this, quickly into that high, that's my point. I'd probably look for possibly the trap up there to trade this back down. Whereas this, I could just see this just grinding and then dropping. So yeah. But I mean, the roll here is perfect. I don't know. That fucking hotkey keeps opening that. The roll here was pretty perfect because this was a 3-day comp. So you traded back to that, briefly accepted in, took that high, and then broke down. So you had a good setup there. Back down to that weekly open. So just mindful of that. So that bearish setup worked out. On the high time frame, this is bearish as well. I think all things are just pointing lower now. Right. As far as the CVD, just because I wanted to talk about that, I just noticed this. I'm not really an indicators guy. I obviously use TPO and profile, but I don't really rely on indicators. CVD is different, right? That's just a volume tool. It's literally just showing you buying volume and selling volume. The problem is on TradingView, there was no true CVD. I think it was just based on tick for the longest time. So whether there's an up movement or a down movement, which we know doesn't have to be the case for a corresponding up move in CVD or a down move in CVD. So you can have it where price moves up, but CVD moves down, because there can be more sellers in a candle than buyers, yet price can still move the opposite direction. So I don't, I've just noticed this. So this is split by session right now. So it restarts at the beginning of the session. You could do this cumulatively all the way to the beginning of time. You could do it to the beginning of the window. You could change all these settings. But I haven't really checked completely across all platforms, and also have not looked into the actual calculation on that and reached out to TradingView to see how they derive this. But it is an official indicator from them, so I'm confident because of that. But again, I just realized this, and someone said that Adam might have looked into this already. It would just be nice if they had something like this. But it's not a community script. It's right from TradingView. Just looking at the chat real quick. What's up, SE? So SZ, probably sees that I just spend most of my time like going to restaurants and hang out with my daughter, because that's all I post. So I wasn't bullshitting when I said I haven't been really focused on the market at all. All right, let's take a look at, has anything happened while we were doing this? No, the S&P is still coiled. So that's why I'm just less, even though I started this and I was talking about the NASDAQ moving up, taking out key levels, it's just higher beta. So more tech, higher beta, this is going to push further, or potentially could push further while the S&P does nothing. And it doesn't mean this is going to drag the S&P up by proxy. The TV CVD is no good. Okay, good to know. I mean, I wasn't sure. Off a quick glance, it looked accurate. No, the Dow isn't open still, Europol. It's moved on to a separate group. It's much smaller. I mean, I think ultimately, and it's the least sophisticated analysis for the S&P right now, because it's really obvious. I think when you have a structure like this, and you can see very quickly that the market has been just absolutely pinned between, we're looking at 41.31 in terms of value and 41.54. It's not even enough to say that acceptance outside of that is going to lead to continuation. Like a lot of times we look at multiple periods of value overlap and inside value, and you look at that and you look for some kind of break from balance, right? Now you have an inside day setup here. You have 3 inside days set up. So maybe in the last 3 days, you could rely a little bit more heavily on that. So you have inside day, inside of this day, inside of the prior. So you have a lot of compression in the last 3 days. I would probably lean on a break of actual extremes more than just, oh, here's where value is. And if you break out of value and we establish, outside of value, then it's going to be the move that leads to expansion. As you see before, the market was just as tight, and we've had a couple different attempts that ended up being deviations, and led to failures, and that, rotated right back towards the center of the range and to the other side. So I think that this structure, the benefit of it is that it's really clean in terms of extremes. So if you get a move through 41, Or again, I think it's, 4,200 is the golden level, but if you get a move through 4171, just think the market has been pinned now going back to the 8th, has had no exposure outside those levels. There's a lot of hedging that is built up in here. So if we're above here, then yeah, I think you're targeting 42. And I'd say that with certainty that it would be very unlikely now for the market to, over the last 3 days, pin. So inside value, complete overlap, and inside structures break outside of this extreme and then just fall flat. So I don't think that you get something like this. I don't think that you get something like this. I think that instead, this is your expansion up to 42. And in the event that we break 41, I think you're looking down around 40.75 and then probably 4K, honestly. When the market spends this much time ranging and pinned and all eyes are on this, when you get some kind of resolution, I think this leads to pretty nasty move in either direction. I mean, I don't look at just the amount of candles to determine acceptance. I think there's a lot that goes into acceptance. If I'm looking at the market trading above a level that it has not been able to prior or through a level, I want to see that it's accepted, not just based on how much time is down there, because that might not leave me with much meat left on the bone, right? If I'm waiting an hour for the market to close through that level, a lot can happen in an hour, right? We talk about ATR and how much the market can move on average. A lot of times I'm going to be trying to do better than that. So I look for absorption. I look for the market to remain rebid or reoffered. If we're breaking, for example, if the S&P is above 4170, do I want to wait for this to close 1 hour outside of it? No. If I'm away from the computer and it does, okay, cool. All right. So, then I'm late to it. But what I'm going to be looking for immediately is does this 4170 level get fortified, right? When we trade back to it, is there a ton of selling that comes into the market that now is being rebid and the market is now accepting higher off of that? So it's just a matter of is new participation coming into the market? Are we seeing the covering is moving the market up, or is it covering with new demand and new buying coming in and getting behind that? So a lot of this is flow related. Time-based, if you're going based on time, if you're using like TPO charts, standard is like 30 minutes. Some people look at daily closes for their daily trade, for their position trades and longer term swing trades. I get that. I think that when you do have, again, like I said in the beginning, the fact that we did have a change in market structure on the weekly, I think that it's something that you don't anticipate is going to lead to the big move in the next 5 minutes after, but it is something that you give respect to actually play out over time. So if you are changing on the high time frame, that's a much bigger change than on the 5 minute time frame. So give this a little bit of time to do its thing. And just to cover back to that, I think that again, at a minimum, with this kind of break, at a minimum, I'm looking at 27.5, right? Before I start reconsidering things. Right? Because a lot of the times with this, again, you'll put in the high on the Monday after this break, and then that was it. That was the high. That was the wick before the much larger leg that ends up filling out that wick. I mean, you've seen examples of that all the way down. So, and there's really not, again, there's not a lot of reason. There's nothing really compelling about positioning that stands out that says, oh no, this is, where is that? This is a trap that is setting up. Right, here we go. I mean, spot is selling pretty heavily into this on Coinbase still. So that's Coinbase spot. We'll adjust that. Show you Binance, same thing. Get a good amount of buying in futures earlier. That is responsible for this increase in open interest. Funding is more positive than anything else, but it's kind of baseline. But again, just bigger picture in this move down right here. So from the low of the move, right? So from this low to where we currently are, which is higher than that. So that's open interest, that's price. I mean, there's no real change, right? This has gone up 5%, and prices off of that gone up for where we are now, basically the same. I mean, it's down 1% from that low. So nothing major that stands out. And that is in BTC value. So it's not being changed by the actual price. This is in USD value. So again, there's no, it's not like this back here. It's not like this back here. If we zoom out just to give you clearer examples of sharp moves in open interest that have led to reversals, I mean, you see very quickly where those are, right? You get the idea where extremes are. And I talked about trading ranges and looking for the extremes in positioning, and you kind of get a clear idea of that just from this chart alone. So there's your high, high. That's the low. So this is kind of like the low would be where you'd say positioning is exhausted or flushed out. And this is where you might say the positioning is exhausted. Right? And this is just a very quick sort of not the best example, but to point out a range in open interest and participation. Where we are right now, nothing that stands out. In terms of ETH, ETH's kind of doing the same thing. You have an inside day set up. ETH's looking a little bit more bullish against BTC, and that's just off of today's session. So, I mean, if we look at ETH BTC, again, today's session, kind of up only. I don't know if this is anything, again, that's going to, as bullish as people are, with respect to ETH, I don't see it doing anything I don't see it like leaving this market behind and trading differently than it has been. So what that means is there's brief periods where it overperforms and BTC is underperforming. But then if BTC breaks down to 25, like ETH is not going to hold. And I think in terms of just high time frame setups, I think with ETH, it's actually, it's different, but it's still, I think it's really clear. So go to this chart because that was taking a second to load. So you had that failed breakout up here, right, on the weekly. Lower highs since then. This can get a little tricky if you're looking, depending on how you're defining the range, right? So where we spend most of the time between 18 and 1K. But I think for all intents and purposes, structure like this for ETH now needs to at least trade back above last week's high. So in order for me to start looking on the long end of things, or the weekly open, so back above the midpoint of this consolidation, that would be where I would start looking for some kind of signs of life, some kind of signs of strength. Just because there's not a whole lot that stands in the way above that. It's not like it left behind anything that's that significant. But yeah, I would need to see that we're back above this pivot. Otherwise, again, these are just probably slowly breaking down. Man, it's even uglier, honestly, if you look at it on the monthly. See if I miss anything. But I think for ETH, I mean, the same as BTC, I don't want to start looking too much lower. I think you end up looking back down here around this sort of meaty area between 1650 and 17. It's not like we're talking about these things, you know, just to be clear, as we're looking at much larger breakdowns in the short term. You know, playing it basically from one sticky point to the next. I just think that the next sticky points we tag, the RR is better to the downside. Gold, I'm not trading gold right now, but you know, gold gets sold. So I talked about this when we popped up back here. I said, give it a couple sessions, gold would be lower. Gold gets sold, right? So BTC, I think, is trading probably closer to gold right now. Three taps of this last 3-year high. I don't know. You know, gold has to do a lot for me to get bullish on it. Otherwise, this is you know, trades like commodity. This could be a multi-year range, right? And we could just put in the high for the year. So I don't know. I'm not like going to sit here and macro LARP. I don't have a good feel for gold, but it seemed like a lot of retail were getting bullish on gold at the high. Gold in, you know, sort of front and center in the narrative. So I wouldn't be surprised if that was a high for a while. I'm pretty upset I got rid of this long yesterday. I was, again, not trading much, but I ended up longing this at 210 and cut this. I'm just looking at the chat now too, guys. So I just wanted to hop on. It was, you know, boring stream, not a whole lot. I think ETH probably offers the same setup, like I said, though. You know, inside day, break above 1850, it's pretty clean level. And maybe you get that extension towards 1880. Again, same kind of structure as BTC, except for the last session. In terms of this move back here. Right, we ended up backfilling that gap. Yeah, I don't know. The NQ is tricky. We have OPEX this week, a bunch of Fed speakers. You have the phenomena that's created, I think, intraday around like 1-2 p.m. from 0-day expiry options, leading to some pretty big moves in the NQ. I'm not going to extrapolate on the NQ too much, though. I think that if the S&P is not above 42, that everything gets pulled down with it if we end up moving lower from here. I don't really take big picture views on the NQ anyway. I'm mostly just trading intra-session, intraday. So once people start talking about where things are going to be in equities, like over a week out, I can't take it that seriously, because it would seem then that they haven't really been paying attention, because the market has just been throwing everybody off their footing. But I could see the NQ doing something before the S&P does. So squeezing out to 14, squeezing out above 13.8, and then having some kind of blow off. I don't think we're in a position right now where market breadth is very supportive of higher prices. I think that it kind of would make sense for the market to continue to fill out and grind higher with explosive moves up, flushes lower, establishing value, and doing that for like a year, honestly. There's no real impetus or reason for the market to suddenly put in a really strong trend upward. So maybe PTJ is right with the grind up, but maybe it's just like what we've had for the last couple months over and over again, right? Where it always feels like the next meeting, the next FOMC, the next CPI is going to be the thing to give this thing some lasting legs, and really missing the point that there's no real reason why much should change now. But I guess, it's interesting to say that, because in the same breath, the next FOMC is going to be really telling, because everyone thinks that this is going to be the one where they don't raise, right? So if they don't raise, then yeah, that is, I think if they don't raise after this meeting, it's a little bit more bullish in the short term than if they didn't raise last meeting. And just to clarify, last meeting, so the one just passed where they hiked by 25, it's obviously much more proximity to the banking crisis, everything that's going on. It would have looked like something was really wrong. So I think a lot of people are making the mistake and think, okay, the market, they don't hike, the market's going to go up. And the truth is, if they would have pivoted too fast, it could have been a very clear sign that something was wrong. And so you would get like a sell-off off of that rather than a move up, or maybe a spike up and then a bigger move down. So I think that if now, after they've hiked and they've kind of changed the language and pulled some out of their, pulled some language out of what they were publishing, that it's a little bit more, I guess, priced in by the market, and it's not going to catch anyone necessarily by surprise or throw anyone off with respect to where the market is headed, which is, feels like a recession that isn't a recession. It's very weird. But Home Depot not putting out guidance moving forward, having one of the worst quarters, I think, in the last 20 years, it's a pretty good sign, right? Probably a pretty good indicator of the consumer. Maybe not as much as Amazon, but so I don't know, guys. I'm probably going to wrap it up. Again, I just wanted to hop on here. What am I mostly trading? If I'm trading currently, I was scalping Pepe, but I'm just primarily a NQ, ES, BTC, and ETH guy. But as of the last 2 weeks, I barely traded, honestly. The only thing I've done the last 2 weeks is, no, I already shared it, YXA. I already talked about this. TVD, CVD, and Delta Bar, sir. I already shared this, dude. Rewind. The only thing I've done the last couple weeks is like remove a hedge, add a short, remove that short, re-add the hedge. And so my average exit, average price from flat is it's between 30,004 and 30,002. I couldn't even tell you what the average is, but I was quite public with it. Yeah, they've been pretty explicit with saying they're not going to stop. So, I think, I don't know. We'll see. Because, listen, I'm not going to try to predict it. It's honestly tiring on Twitter to see so many people try to predict it, and it's better to just actually see exactly what they do and react and respond. Yeah, if we end up coming back down to 25, we'll see. Maybe I'll add a little spot there as just a value buy. I think no matter what, into 24, 25. So not talking about price right now, but 2024, 2025. I think that there's probably just a good amount of symmetry between this, market and the last cycle. So looking at kind of just prior high, well, current high, current place, 79 bars, 79 weeks, 79. I think just it's a good case to be made for this kind of loosely resembling prior cycles, right? Loosely. And then the break of the all-time high into halving, post-halving, about 73 bars from that. And again, this is not science. This is me just vaguely giving an idea of the overall, I don't know, rhythm or cadence or pace. I think, like I've said many times, end of 2024 into 2025, maybe we get a new all-time high. Obviously monitoring for any major changes, but the point of that really is not like to guarantee any kind of price, but to say there's a lot of space where nothing can really happen, right? There's a lot of opportunity for range and just kind of boring price action. And if you look at ETH, I think it's maybe even a little bit, let's see. Again, not an exact science, obviously. But the implication is if we're going to resemble past cycles, there's a lot of room. So coming back down here would be completely normal. But that's it, guys. I think I'm going to wrap it up. I just wanted to hop on here. I will hop on again on Thursday. All right. Hope you guys have a fantastic day. Check out the links below.